Welcome and thank you for joining us this afternoon for our investment webinar. I'm Chris Lawson, Director of Lansdown Place, and in a couple of minutes I'll hand over to my business partner, Graham Lewis, and to our main events and special guest speaker, Darren Johnson. Darren is Head of Engagement with the St James Place Investment Consultancy team. Some of you may already have seen Darren at one of our previous events, back in the days when presentations could be delivered to an audience sat in the same room. Whatever the presentation method, Darren has that rare ability to find a way of translating technical market information into something both interesting and relatable, which has proved invaluable to myself and the rest of the team at Lansdown Place over the past few years. Before I hand over to Graham and Darren, I'd just like to run through how the session will run. During the webinar, your microphone and video will be turned off, but despite the fact that we cannot see or hear you, we really do want you to participate. Having the opportunity to hear from someone like Darren is great. We didn't want to spend the next 40 minutes simply running through a PowerPoint presentation. Instead, the idea of this session is to give you the opportunity to ask a senior member of the SJP investment team any questions you might have. Investment related only questions, please, even though I'm sure Darren will be only too happy to go off piste. I'm delighted that some of you have already sent in some questions, but if any further questions spring to mind during this session, please use the message facility provided, which I hope you'll find straightforward to use. On your screen, you should see a little control bar labeled Go to Webinar. If you click on the little orange arrow and scroll down to an area marked Questions, you can type in your question and then click Submit. Of course, if the technology defeats you and you'd rather submit your questions via email, please use the email address that you can see on screen now. It's the same email address that we use for our weekly updates, so you should already have this. Following a quick 10-minute overview of the markets, Darren and Graham will run through as many questions as they can before we close the webinar at 3:45. We hope that you'll keep Graham and Darren busy, and so if we do run out of time, we'll be in touch in the next day or so to respond to any questions that we didn't get a chance to cover off today. And now, without further ado, I'll hand over to Graham and Darren.
Thanks, Chris. Good afternoon all, and thanks for joining us. And again, my thanks to Darren for taking time out to speak to us and to you today on an area that's obviously close to all of our hearts and in all of our interests. So before we start with some questions, Darren, over to you. Ready? Just a quick overview from yourself about you and your current thoughts on where we sit in the economy at the moment.
Thanks, Graham, and thank you to everyone who's joined us this afternoon. I hope everyone is safe and well and has navigated the last few months in being safe and well. And I think as we go forward, there's a lot of questions that are going to be asked during this next half an hour, or hopefully will be, where focusing on what next. But actually, what I want to sort of start here is almost what we've been through and trying to make sense of it, really, because I think this is the first market crisis that we're aware of where nobody's got anything else to do other than worry. In previous downturns or economic issues, we've had distractions, whether it be being able to go somewhere, even just going out of your house was a luxury at one point. So I think where the best place to start really will be what's going on in the UK, but then look around the world and frame what's happening right now. So I think taking a step back, sorry, I didn't quite introduce myself, but for those who haven't seen me speak before, I'm head of engagement within the investment consultancy team, and me and my team, our job is to go around talking to investors, talking to advisors about what's going on, and essentially making it relatable and taking out the complexity of it. And I think that's never been more relevant than it is today. So starting in the UK, because that's what we're bombarded with on a daily basis, is the doom and gloom that's going on in the UK right now. And I'm not going to necessarily paint a rosy picture, because what we're dealing with is where we are today. And the way I always talk about where we are today is we're in the eye of the storm, i.e. we don't quite know what the solution is, because we don't quite know what the damage is that's being done as we speak here right now. So we are in that awkward situation where probably there will be a question of, well, how long is a recovery going to take? And actually, we don't even know how long the slump is going to be before we know how long the recovery is going to take. So the UK, where we are right now, the markets, so if you just take the FTSE 100, most people will be aware that there's been quite a significant bounce in the last 2 months. The bottom of the market was the 24th of March. lockdown started on the 23rd of March. And so, one day after lockdown was officially sanctioned, you saw the FTSE start bouncing. Now, a big part of that is because equities are what we call an anticipatory asset class, which means that it tries to predict the future with varying success rates. But I think it's causing a lot of confusion that how on earth can everyone be locked down and no one working and markets go up? And it's simply because what the market is pricing in is 6, 9, 12 months down the line, some sort of recovery. Now, I think there's various technicalities around that where the UK is concerned. So a recession is technically consecutive quarters of negativity. Their standard comes to a point where it can't get worse. So merely on a technicality, you come out of recession because things can't get worse, and that's what we're going to. For example, so Q2 and quarter 2 and quarter 3 there's an assumption that it's going to be the worst ever, and it will be. When we get to the end of quarter 2, it will be the worst quarter ever, and we can debate how bad that is, but it will be 8 times worse than any quarter in history. So we're not even talking marginal. So therefore, what the market is looking at is 6, 9, 12 months down the line, where economically things are growing again, but it's growing from a lower base than it was before. But it's growth nonetheless. So I don't want to say that the market is painting a rosy picture. It's not, but it's pricing in some sort of growth.
Okay.
Now, so and also then later on in the year. So the market firstly isn't moving on virus numbers or infection numbers or death numbers anymore. That's long gone. Those days are long gone. The market is now moving on what the world looks like in 6, 9 months time. Now in 6 months time, we're going to be dealing with the word Brexit again. So therefore, I'm bringing it up before anyone else is. That hasn't gone away. Nothing's changed on that. So everything that I said in various events over the last 6, 9, 12 months, everything is just as relevant towards the end of this year. It's just that we are in the middle of a health crisis, an economic crisis, a market crisis that nobody saw coming. But Brexit is a known unknown, if that makes sense. So the virus came out of nowhere, and that's why you saw the market reaction you did.
Right.
Now, the problem where Brexit is concerned is we know the market has been living with this since 2016. So we're not anticipating a huge amount of volatility, but it is something nonetheless that is hanging over the UK market that, of course, is not hanging over any other market around the world. Which then brings me to the US and trying to make sense of what's going on over there at the moment. Look, I'm going to try and not be political. I'm going to try and not give away any leanings there and focus on what's happening from the market, from a market and economic point of view. But it's impossible to ignore what's happening socially over there right now. And who knows where that's going to end. So you've now had 9 consecutive nights of multi-city. There's now been protests in every single state, whether they are red state, blue state. So this goes beyond politics to a point. And where it ends, you don't know. It could amplify even further if Trump's rhetoric carries on, or it could peter out as it has done previously in times like this. So that's impossible to know. However, you're in a market where things have just continued to go up regardless. And a lot of that is to do with the fact that the US market, which is essentially 500 stocks at the top end, has been driven by 5 individual stocks that now make up 23% of that market. So Apple, Amazon, Facebook, Microsoft, and Google make up 23% of a 500 stock market. The S&P 500 is now only 3% lower than it was pre-coronavirus, and yet the average stock is down 19%, which tells you that 495 stocks are suffering. So the US economy is not. So taking the US market as it's only fallen 3% does not mean the US economy is thriving.
Down by 3%.
Absolutely is not, and that will come out over time as well. So the US market, we've got quite heavy concerns over the concentration towards 5 stocks. They are truly the world's first global entities. That you haven't seen companies like this before. But if you say that 1999 was the first tech bubble, that was 18% of the market at that point. It's now 23 and growing. So you are seeing previous bubbles even further now. And where this ends, we don't know. Again, there's a lot we don't know here, but I think what's important to recognize is there are certain market trends that have happened before that go way beyond coronavirus that we're not ignoring. This isn't a one factor market by any means, and we haven't even talked about the oil price. The oil going into negative territory. I'm not sure we'll ever see that again. But ultimately, there were all these things that were happening at once that went beyond just the virus numbers. So it was almost snowball and eye of the storm stuff, like we said. And then I'm sure we'll talk about the US election later on, so I won't cover it too much. But the US election is in November,
Sure.
which I'm sure we'll get onto. Asia and emerging markets have coped with this pretty well. I'm not going to be casual about the pandemic or what is obviously a global pandemic, but many Asian countries have seen things like this before, so coped relatively comfortably with it in terms of lockdown measures and quarantine measures and things like that. And we even saw it at fund management level. Asian and emerging market fund managers sort of dealt with this better because they'd seen it before. They knew what the trends were after that, the behavioural signs to look for. And US and UK managers didn't cope with it well because it was unprecedented territory. And then finally, Europe, before we go on to the questions, Europe was hardly in a boom period anyway, and this is just one extra thing for it to cope with. Everything that we've worried about in Greece and Italy, etc., over the last 9 years hasn't been sorted out. So therefore, I can't really paint a rosy picture there either. But I think overall, all the unknowns and all the concerns and all the uncertainties that were there before have now had added uncertainties laid onto it. And I think it wouldn't be a surprise to anyone on here for me to finish this section by saying that the need for advice is pretty much higher than ever because there's more uncertainty in the world than ever.
Sure.
The need for a good fund manager and a good financial advisor to me is as high now as it's ever been. And until the world is rosy and everything is predictable, that's going to continue to be the case, I think. So if you're happy to go to questions, I think we can delve deeper into what we said.
And I think as we go through, I think one of the things that will come out of this is what you just said about advice and good fund management. And there is still some great opportunity in the markets, isn't there, which we're now trying and capture to deliver that growth for clients over the next period of time, which is uncertain, obviously. But the first question that got sent in to us was this one: what concerns do you and the fund managers have around the second spike in coronavirus and obviously a second fall in the markets and then subsequent recession? And I think the follow-up kind of links onto that and what keeps you awake at night, and is it markets?
Lately, heat, children. But it's I mean that's a fair question. I think we spend more time in our portfolio meetings talking about what can go wrong than we do talking about what can go right. So I think if you avoid the mistakes, then the upsides tend to take care of themselves because over time markets rise. So the biggest damage to long-term returns is not missing out on an opportunity, it's making a mistake and starting from square one and having to recover for longer than you otherwise would have had to if you hadn't made that mistake. So wasted years we talk about a lot. If you fall 50%, it takes you 100% to get back, which can take years. Now, ultimately, what concerns do we have over a second spike? I think from a social point of view, huge. Quite clearly, we're human beings as well. We've got families, etc. So on a social level, I mean, I'm married to a biology teacher, so she goes into some quite scientific depth about what's going on that I sort of nod and pretend that I understand what she's saying. But ultimately, from what I can make sense of, this goes one of two ways. And I think where you can relate that to markets is those two ways are either you find a vaccine or at the very least, a treatment that prevents the threat of death. I think that's you can function as an economy with this if there is an effective treatment that people don't have to fear that their family is going to pass away. So I think there's a lot of focus on a vaccine, but I don't. That is almost the absolute safe haven here. But actually, an effective treatment would be just as good for the economy to function again, that people can have the comfort that they can go about their whatever normal lives will be without the threat that they can pass on something that's ultimately going to do damage to their family and loved ones. Or there is a second wave, and that doesn't seem that seems to be the two options. And what we would say where markets are concerned, we'd be very surprised if markets finish the year at this level, because there's either going to be a huge positive in the way of a vaccine or a treatment, or there's going to be a huge negative in terms of a second wave. Now, at the moment, that almost feels like we're in heads or tails territory then, in which case there's a need for diversification of asset class. There's a need to just carry on with the path that you're on, rather than trying to guess, will it go for me or will it go against me? Because if you get either of those things wrong, that's the mistake. Is if you think everything's going to go up and it goes down, you almost double down on the damage you've done, and vice versa. If you put everything into cash right now and everything flies, when do you get in again?
Sure.
So there can be more damage done by making a judgment that it's going to go one way or the other right now. Whereas the boring answer is you navigate your way through it in the same way that you would any other scenario, whether it be Brexit, Trump, North Korea, Middle East, whatever it be. But sorry, someone got some echo there. Sorry. So I think subsequent recession. There won't be a second recession, because a second spike would just cause the recession to carry on.
Sure.
So I guess that's the only positive thing I can say about that. I know there's previous recessions get talked about quite a lot, and I think we get a lot of questions. Certainly there's been articles lately about the worst recessions in history, and this will be the worst recession in 300 years, which yes, it will be. What we would probably not to downplay it too much, but the 18th century, the world wasn't the same as now. It wasn't functioning on the same levels as now. What caused recessions in the 17th century was generally weather and your agriculture failing. That isn't going to cause, that now isn't going to cause recessions in the same way. So I think while it looks good in a headline of it's the worst recession in 300 years, I'm not sure that anything is comparable to this. In that way. And the same goes for if you look at previous global pandemics as well, because 1918, 1919 is held up as with Spanish flu, and that's where the second spike theory comes from. But there was a lot of reasons for that, in that nobody knew it was around the first time to prevent the second time.
Right.
People lived in far worse conditions. Healthcare was worse. The idea of lockdown in 1918 wasn't. It's called Spanish flu because it was only Spain that were public about it. By all accounts, it started in the US, but nobody talked. So I think we can talk about global pandemics and previous pandemics and talk about curves and things like that, but the world is far different now.
But no real comparison because of where we are now.
No, anticipations of second spikes. I mean, viruses generally take second spikes because you get a mutation and then you get the world. You have to play. You're chasing down whatever the treatment or the vaccination is. But in terms of what keeps us awake at night, it's pretty much that. But with the added, what we're asking our fund managers to do is predict what the world looks like in 5-10 years time, and this muddies the water because there's a lot of things that can happen in the next. I mean, it feels like 5 years has passed in the last 3 months. And what you tend to get out of things like this is trends accelerate. So the work, even a working from home trend. Everyone talked about flexible working for years. It was never going to happen, but it was forced to happen. So then that almost accelerates that trend. Everyone suddenly got Netflix. Everyone's, because they're in the house more. There's all these technological solutions to things that were going to come through anyway, but it just accelerated it through. So there'll be winners and losers in this. But it's a fund manager's job to identify what the winners are almost before everyone else does, and identify what the spending habits are going to be before they are. And I think, again, not necessarily keeping me awake at night as a long-term problem, but the world is still in the grip of maybe a political wave changing. And you could say, well, Trump's re-election for a second term wouldn't necessarily see a change, but I think socially it very much would.
Sure.
So I think short term it's virus related, but long term it goes back to the age-old problem of political stuff again that has caused the problems for the last 4 years.
Sure. Well, that leads us actually into question 2, Darren, quite nicely actually, which is thinking about. I mean, we all get obviously so focused now on Corona, which is absolutely spot on, but there are other things obviously still happening in the world. We've obviously got issues now with China and Hong Kong still ongoing. China-US tensions are still high. And to summarize this question, really, I guess what our questioner is asking is, what's the impact of the China-Hong Kong issue going to be, and what's the China US trade issues going to be, and how big are they going to affect the markets?
Yeah, so okay, there's several different angles to this. If somebody had asked me in January my belief that the biggest market factor would be this year, I'd have said the US election in November.
Yeah, sure.
If someone asked me now what I think it would be, I'd probably give the same answer. And yet the strange thing is, we're in this global pandemic that nobody alive has ever seen the like of, and yet the biggest factor probably at the moment in the direction of markets and economies over the next few years will probably be whether Trump is re-elected or not. Now, the reason that that's relevant to China is that China, so if you think of what Trump's playbook was in 2016, where Mexico, the wall this, the wall that, well, just put, for 2020, just put China in instead of Mexico. And he's been given the opportunity to do that and appeal to the base. And so that's why China is so important to, even to the future of the US economy, because indirectly, China-US relations are not going to improve this side of an election, for the simple reason that the rhetoric will not stop, because he's got an election to win, and it's all about that. A cynic would suggest that all of the publicity stunts around having your photo taken, etc., is about election. It's not about calming rioting down or things like that. I'm conscious that this is being recorded, so that could come back and bite me. But you see where I'm getting at is there's a lot more to this, the whole US thing, and a lot more to the China thing than just one factor or another. It's all interlinked as far as we're concerned.
Right.
So where China is concerned, I think saying we're going to do less business with China and doing less business with China are two different things.
Sure.
In this world. So that's for two reasons. One is, if you can get goods cheaper from China than produce them yourself, it's a brave economy in this environment that says we're going to make these things ourselves. Secondly, the consumer in this economic environment, i.e. potential high unemployment, economic recession, low confidence in purchasing, you've also got to hope that the population accepts higher prices. Because if it costs more to produce than get it from China, you've got to hope that your consumer base is happy to pay more rather than import it from China. And that's why we don't necessarily think that, I think protectionism, as it's called, rather than globalization, I think you might see a short-term issue with that, but a lot of it over the long term, I'm not sure you're going to see the global population refuse or expect to pay more from something that they know they can get cheaper if they just order it off Amazon.
Yeah,
I mean, this is where we are. Also, then if you look at it the other way around, China's got, if you're a business based in the US, in the UK, and you are being told that you cannot do business in certain areas, it's a brave company and a brave government that says you are not allowed to do business with the biggest population in the world, or one of the biggest or richest populations in the world. There's 1.2 billion people there that are willing to spend money on your goods. Again, that's a brave government that says my economy doesn't need 16% of the world's population.
Yeah.
I think, like I said, saying and doing it, two different things. So I actually agree. I mean, it may benefit UK manufacturing and create jobs if production was brought home. I've got absolutely no doubt that is the case. But you need the demand there from the consumer base to do it, and I'm not sure that is
the appetite's not there. Yeah.
No, I mean, how can you go out to a population now and say as a government, well, all your prices are going to go up 20%, but at least we'll create jobs for you? I'm not sure that is going to be. I think the jobs bit is going to be admirable, but you've still got to convince people to pay more during a time when nobody. I mean, we haven't talked about furloughing, but there's a lot of. We don't even know yet whether mass furloughing will turn into deferred redundancies. So again, eye of the storm stuff. But yeah, I think where it says on this question, even if goods are slightly more expensive as a result, and it was when I read through the question just now, the first thing that jumped out was I'm not sure we wouldn't be talking slightly more expensive. We'd be talking significantly more expensive.
More expensive, sure. Yeah. I mean, the next question actually, which links into this, is very much specifically around the US election. When you and I have talked in the past quite a bit about the power base of the US economy and how, going back 6-12 months ago, Trump was riding on a wave as far as the US citizens were concerned because he was doing, from their perception, everything that they wanted to get the economy of the US moving. And it was almost a shoo-in that he would get elected. What will he do now, or try and do you think, to try and make sure that kind of continuing wave of getting him back into power will continue? Will he make further tax cuts? What can he do? How will that affect the economy going forward?
So if in January, again, it's funny to say in January, as if it's a decade ago, and but the world has flipped so quickly.
Yeah, I've got written down notes of what you said in January, Darren.
Yeah, so I'm sure you have, but in January, if you'd said to me, is Trump going to win the election, I'd say there's absolutely no doubt in my mind that Trump is going to win the election. There would have been no president in history who would have lost an election from the position that he had, i.e. lowest unemployment in history, longest bull market in history, largest economic upturn in history, combined, lowest tax rates, all these different things. People don't lose elections from those positions. In the space of 3 months essentially, but in 5 months on now, what I'm going to say to you is he's not going to walk it, but at least it's going to be close now.
Okay.
So therefore, and a lot of that is his own doing. But if you add 24 million unemployed in 3 weeks, that's going to have a knock-on impact, not just on the 24 million people, but on their families, maybe even entire towns. There's massive industrial issues here in red states, as they're called. So Trump voting states that in January you even have thought, he wouldn't even have had to campaign there. Now there's going to be a lot of people who are out of pocket, who are feeling the economic pinch before the election. So if you said to me in January, what could be damage hit him, would be mass unemployment and an economic recession. And in January, there was no chance of that. Now there is, and people lose elections from those points. And therefore, because what tends to happen is it's almost the easiest campaign for an opposition to ever run, which is, this is all their fault. Because and you see it opposition throughout history, wherever,
of course,
where people feel that they're struggling, you vote for change. You could even argue that there are various referendums around the world that have been about that voting for change because you don't feel you've got anything to lose for voting for the same. And I think what effect will the US election have on global recovery? I think this is where you toy between social and political aspects and market aspects. What the market wants is almost the known unknown of Trump. And that's a strange thing to say, given that there's social unrest and there's all these different underlying issues going on. The market will want what it's already got. It would always do that. You'd rather deal with the problem you know about than deal with sweeping change.
Sure.
Is there a bigger concern than the current US-China issues? Probably not, because the US makes up 24% of the world's economy and China makes up about 15. So together, that's 40. If you've got the US and China, at loggerheads, that's 40% of the world's economy that the other 60% just cannot carry the weight of. So if they go down a mutually destructive path economically and start saying you can't do this, you can't do that, sanctions this, sanctions that, that's 40% of the global economy affected in a blink of an eye, amidst what's going on at the moment. I'm just. So what effect will it have on the global recovery? It could slow it down. It could. I don't think you can't hinder it forever, because that's just the nature of economic cycles. Things always get back to where they are. It just takes various number of years to get there. But I think if the biggest damage would be probably if Trump won the election and completely cut all ties with China. But I cannot.
Realistically, that can't happen, can it?
I can't. I mean, this could really come back to bite me. I cannot get into it. He would be that silly.
Yeah. It's probably best we move on, Darren, isn't it?
Yeah.
If we can come back to the UK a bit more, actually. One of the questions we've had is around UK dividends and the ability to maintain dividend payments and what impact that will have on UK investors. As we all know, the dividend is often a big part of the return. And if dividends are having to be cut because of the current situation, what does that look like for the UK economy and UK equities generally?
Yeah, I think yeah, this is also where you start talking. So the reason that this is so relevant to the UK, I think, is because in March our main equity market yielded 6%. I mean, that is absolutely astronomical. It's 6%, and a lot of those companies couldn't afford to be paying the yields that they did. They just felt they had to, because you get swept with a wave of it. If everyone else is doing it, then we have to.
Sure.
Excuse me. I'm not allowed to cough on camera nowadays. Sorry.
Everyone's ducking now.
I know. Yeah. Just thought that. So as somebody quite rightly pointed out very early in this, if every company on the FTSE 100 halved their dividend, we would still pay the highest dividend yield in the world. So therefore, we were paying 6, and no one else even comes close to 3 even. So therefore, every company could very much afford. You could even say there was an argument for it, because what traditionally your income yield is quite closely married up with your cash and inflation returns, because what companies want you to do is buy their stock, and in return they give you an inflation beating yield to keep your money. That's essentially what it is. Now, over the last 10, 15 years, cash has gone down and down and down, inflation has gone down, and the yield stayed the same. And there's absolutely no reason why traditionally it would have had to, other than people wanted to. People wanted it. Yeah. So I think there is an argument that says, well, the ability of the companies being able to maintain dividends, no. I'm not going to say it's going to bounce back to 6%. A lot of these companies don't even know what they can do in the next 6 months in terms of trades, let alone think about paying a dividend. One of the things, I know Legal & General paid a dividend today and paid out, billions, and yet 80% of their staff are on furlough. That's not a good look. That's there's a moral quandary around that. That's not just can that company afford it? It's
sure.
And a lot of shareholders did not like it. And a lot of fund managers didn't like it and sold the stock, because that's not an ethical thing to be attached to. But I think where maintain dividends, they will pay a dividend, but they will pay what they have to pay, if that makes sense. So
almost what they can get away with, or
it's not what they can get away with. What can be what's an attractive yield? And so in a 0.1% cash world, in a 1% gilts world, in a inflation 1% world, what's an attractive yield?
Yeah.
Well, you could argue that 2 to 3 is an attractive yield.
It's actually very nice. Yeah.
It's 30 times more than cash.
Yeah.
Well, if cash was 4, that's the equivalent of 120% yield. So on the multiples, it's what's attractive, and I think what's attractive in numerical terms is not necessarily what's attractive for investors who are used to 5-6%. So where this then goes for investors is we need to get used to lower yields, because risk-free returns are less, inflation's less, so there is no incentive. Why would a company going through this pay you 6%? It's
if they can do it, okay.
We would almost judge that company as quite strange, because why would you give going through this? What is it? Shell cut its dividend because on average it pays out $16 billion a year. Well, at this time they probably need that. So I think it's what the investor wants and what the company needs are probably two different things. So what it means for investors going forward, lower yields undoubtedly. Now what it means for those who are going to or maybe taking a 4% withdrawal, for example, most people now fix their withdrawals, and I think that gives us as investors on your behalf far more flexibility in how we get that 4%. Okay. So I think traditionally we'd have got it through income yield, through dividends, but if we need to maybe say 2% dividends and 2% growth, then we can be flexible enough to do that. So I think what this means for investors, as far as we can see, is your 4% income need is still the same, but we don't necessarily, it doesn't need to come from dividends. It can come from market return.
So for our clients, they'll be able to maintain their overall income position, but we'll be structuring it as a fund manager differently to achieve that for them.
Yes, I'm not going to say it's harder to get.
Of course, yes.
That's our job.
Yeah,
is to achieve what that objective is. So it hasn't changed our view of our ability to deliver that income. It's that we probably find in that income different areas than we traditionally would have done, where companies were more than willing to chuck 6% at you. So it was quite easy, 4% income yield. Now, where we go on with the second part of this question, which is with the distinct possibility of negative interest rates in the UK, I mean, this is where we've got to now in the blink of an eye. Is now what was inconceivable 4 months ago. What plans do we have on this issue? I don't think much changes, to be honest, because we've almost written off cash as an asset class. If cash isn't beating inflation, it's almost pointless over the long term.
Sure.
So it's about, the Benjamin Graham quote about long-term investing is about managing risk and not avoiding it. To make a long-term return, you've always had to manage risk. If you avoid risk, you're guaranteeing yourself a poor outcome. I mean, it makes me laugh that the Bank of England base rate is 0.1%. I'd love to do a straw poll on this and ask anyone if anyone's getting 0.1%.
Sure.
I don't know anyone who's getting 0.1% on an instant access account, especially.
Yeah.
And yet inflation is 0.8, and it's not going to be 0.8 forever. You're already seeing oil price going up. You'll see petrol demand go up, so you will see petrol prices go up. But that's going to be the biggest inflationary driver over the next 3 months. Combined with, if people go back to work and start spending money again, inflation will go up. It's very much demand.
The differential will get bigger and bigger all the time, won't it? Because the interest rates won't back up that quickly.
Even if inflation got back up to 2, and I'm sure there's an audience here who are thinking, well, 2% is nothing. It's 20 times more than cash.
Yeah.
So you need 20 years to even offset 1 year of inflation. We've never been in this position. So the possibility of negative rates, it wouldn't change our view of what is needed. Because
so cash is still really important just to hold as a going out and being able to get something instant access, but the actual real drive is putting it into investments to grow that money as much as we can.
Your long-term objective will not be achieved in the current environment with high levels of cash.
Sure. Okay, I am conscious of time, so we'll move on to the next question if we can, Darren. It's around the property fund and general commercial properties worldwide at the moment. So this question was on the back of obviously SJP, along with every other fund house in the UK and most fund houses around the world, having to restrict movement in and out of its property fund, the commercial fund at the moment, and closing it to protect the long-term stability and protect the fund for the ultimate investors. Your view on how and when those funds will open and what that will look like?
Yeah, so how many times have you heard somebody say, we're following the government guidelines? I mean, that's pretty much the answer to the first bit. So when will it be available to trade? The fund is suspended because, quite simply, we can't get people into the buildings in order to value them. Property is a very old-fashioned asset class in that it's not a number on a screen like an equity. It's people going in and saying that's worth this. Now, unfortunately, even if there's one property we can't get people into, we can't value it. And if we can't value it, it's a breach of regulation to guess. So, and nor would any investor want us to guess what their fund is worth. And so that's why. So this isn't an SJP problem. Underneath it, they're actually Orchard Street, who are our fund managers, are managing it as if it's open. So there's still a sale. A sale went through last week for an industrial unit up north, which they agreed the sale in January, and it went through on exactly the same value 2 weeks ago. So lockdown meant nothing to that. It still went through, and it was 24% higher than it was this time last year. Or sorry, 24%. The reason they sold it was 24% higher than they valued it at. So therefore, you could say, I think we've had a couple of people say, are we selling things because we have to? Well, no, but if somebody offers you 24% more than you think it's worth,
thank you very much.
Would sell that asset, whatever it was, especially when you're talking sort of £12 million. Also, we're seeing renegotiation of contracts, as you'd expect, but we're also seeing new tenants coming in. So, for example, we're seeing a lot about pubs and restaurants and cinemas being under pressure for a significant period of time. But we haven't quite done the deal yet. But there's a group of an area of units in Nottingham, which one restaurant chain wants to sign up for all of them on a 20-year lease. Now,
that's unheard of.
If restaurant chains and pubs and things like that were really seeing long-term concern, no one would be signing up to 20-year leases. So we're sort of seeing these things going on in the background, and it doesn't quite marry up with what we're seeing in the news and things like that. Now, I mean, we could just be the exception, but I can't imagine we are. Some other property funds will be seeing this as well. And probably the other thing to point out about the commercial property sector is, your main source of return has always been rental income.
Yeah.
which means that the tenant is absolutely paramount in this. And it's going to be a tough time for a lot of companies to be able to pay rent and things like that. We very deliberately have diversified our rental income. So, for example, we've got 622 companies as tenants. The maximum exposure we have to any one single company as a tenant is 0.3%. So therefore, default risk, which has always been a risk in property funds, is huge in some. So anecdotally, we've seen things in the trade press, etc., where one property fund had 8% exposure to Debenhams. Well, coronavirus didn't really change Debenhams. I mean, Debenhams has been talked about as a problem for a while.
Yeah.
If you've got 8% of your rental income exposed to one company on the high street, then you'd probably be worried about that anyway. Our maximum is 0.3, and we've got 622 different companies paying us the rent, and we think that's going to make it more robust as well. So we've decided to focus on that. So I think it's short term, it's highly inconvenient that it's suspended, but it's for pandemic reasons, not fund reasons.
Sure. I mean, you mentioned diversification a number of times, Darren, and again, we're diversifying really well through the commercial property fund, which again just shows it becomes much more stable and less volatile for clients and much easier.
Geographically by sector, so it's not just retail, there's office space, which again has got its own problems at the moment, particularly in places like London. There's industrial units, warehousing, there's motorway service stations in there, there's garden centres. There's all these weird and wonderful things that all of it's property, but it's not. I think people just think high street and they think offices. It's not. It's far more diversified than that, and like I said, geographically too.
Again, I'm really conscious of time, and we could open up a huge area on ethical and renewable energy, which I don't want to do right now, if that's okay. Perhaps we can come back and we can respond to that question post this section with an email or whatever. I'd just quite like to get to the last question, if that's okay, before we close, which I guess a lot of clients are asking is, what can I expect from my portfolio over the next 12 months? So a big question, which I'd ask you to try and close off in maybe 3 minutes.
Yeah, my crystal ball's in the other room. So yeah, what can I expect? I think, as I alluded to, where we're at right now, it's difficult to see that there isn't either a positive short-term outcome or a negative one. It's either going to get worse or it gets better. It's not going to stay as it is. So therefore, we don't know which way that goes. But what I would say is, I know the question says 12 months, but if I could take you to the assumption over time that everything grows. So markets grow, economies grow, population grows, the amount of money people spend grows. Now, if that theory holds true, and there's nothing to suggest it won't, so over the long term, you can run a 40-year chart where markets have gone rapidly up, and yet individually, there's each individual thing that's happened, 9/11, the banking crisis, coronavirus, etc. The biggest thing in the world at any given time, but the world moves on. Now, to get back to where the FTSE was, so just to take the FTSE, to get back to where the FTSE was last week, you'd have had to go up 30%. So if we're all of the view that equity markets grow over time, you're almost assuming that there is 30% upside at least from an investment today.
Yeah.
Okay. At Bank of England official cash rates, 30% would take you 300 years to achieve. So therefore, if somebody said to me, is it a good time to invest in stock markets today? Just by making the assumption that markets will find their way back to where they were, I can put a hefty case together to say that is going to be some point in the next 300 years. Now, the average recovery from a market fall of 30% or more is 3.5 years.
Okay.
So even if this is worse than average, and there will be those on here who say, yes, this is worse, it's going to be worse. Even if it took 10 years, so the longest it's ever taken is 9, by the way. The longest recovery in history was 9 years to get back to where it was. So even if you say 10, 30% divided by 10, 2.5 to 3% per annum. Even with the worst recovery in history, you're making far more than you would if you put the money in the bank right now.
Sure.
Because that's how artificially low these things are, and could get lower.
Yeah.
So therefore, if it's the average, this is where it starts getting interesting as a good time to invest, is if it's the average, i.e. 3.5 years, that's about 8 to 9% per year.
Yeah.
If it's better than average, you start talking at double figures. We're not going to get into those prediction territories, but even if you start saying it's the worst ever, still your multiples and your potential return, and that's even getting beyond that's just getting back to where it was. That's not then what happens beyond that.
So from here going forward, we should be in a good position.
Yeah, I think the biggest mistake anyone can do right now is go through what they've been through for the last 3 months, put the money now into cash,
absolutely,
let the market go up, and then get in at that point. I think you'll have gone through the last 3 months for no reason. What we've got to trust now is that economic cycles do what they do, market cycles do what they do, viruses do what they do, which is peter out over time, as well as our fund managers do the job and add the extra value on the top and get your money back quicker than they otherwise would. And I think that's where all these things can work together to ultimately, is it a good time to invest? Time will tell, but history states that, yes, it does look at that, because when you just look at the numbers, it shouldn't be difficult to beat cash from these levels over the long term.
Darren, I could go on talking to you for ages. Thank you so much for your time. I do appreciate it. And I will hand back to Chris. Thanks, Darren.
Yeah, thanks to both of you. And my thanks also to those of you that provided some great questions. There were some really interesting points made, and I hope you found the session as useful as I did. We've come to the end of our webinar now, but before we finish, I have a small favour to ask all of you. It's so important when we put things together like this to get your feedback, as it helps us improve on our future events. So please do take a couple of minutes to complete the short questionnaire that we'll send you following this webinar. As I said earlier, we'll follow up on any questions that we weren't able to cover today, and I can also confirm that we'll send you a link to a recording of this webinar so that you can watch it at your leisure to refresh your memory on any of the points made. And of course, feel free to share this link with any of your family or your friends. That's it from us. It leaves me to say thank you once again to Darren and Graham, and of course to all of you for taking time to join us this afternoon. I wish you all well, and please stay safe. Thank you.
Thank you.